Hi, today's topic is the origin of goodwill. Hopefully we are going to show you how goodwill is created, when it starts, when it stops, when it is damaged, and how to measure it and how to value it. In order to understand what the professional markets think goodwill is, according to the legal industry, the Whitman Smith Motor Company versus Chapman back in 1934 came up with the dog, cat and rat principle. The law considers goodwill to be based on that principle, and it has been that way since 1934 to 1998. It assumed goodwill was based on what customers do. This is simply not correct. Some businesses do not have repeat customers. Customers do not control business. Management do. So now let's look at what accountants think goodwill is. Accountants do not class goodwill as an asset because they say, and I quote, "If it cannot be reliably measured, then it does not satisfy their current definition of an asset." The accountant's definition of goodwill is: goodwill means the future benefits from unidentifiable assets. Knowledgeable business people buy and sell goodwill every day, and hopefully I will be able to convince accountants that goodwill is identifiable and it can be reliably measured. Now that brings us to my definition of goodwill. Goodwill is an intangible asset capable of measurement and transfer, represented by revenue streams, either presently or prospectively, derived from employing all identifiable assets used by an entity to attract and maintain revenue streams. Now, if revenue streams cannot be transferred to another, they will not attract value. Consider for a moment if you're a musician, songwriter, architect, doctor, specialist, rocket scientist, and the like. Now, there is one other case in America, in the state of Pennsylvania, and that's the case of Solomon versus Solomon. And the chap who ran that business, it was a vet, and it was held that the income from one party was personal. I propose to show you how goodwill is created and how to value it. Step one, you decide to go and start a business today, and you go out and buy $50,000 worth of stock. What do you have at the end of the day? Simple, $50,000 worth of stock. The next day you go out and you buy $100,000 worth of plant and equipment. So what do you have at the end of the second day? $50,000 worth of stock and $100,000 worth of plant and equipment. Do you have any goodwill? No, not at this stage. The next week you begin trading and you now create $100,000 worth of sales. So at the end of that week, what do you have? You still have your $50,000 worth of stock, you still have your $100,000 worth of plant and equipment, but now you have $2,000 worth of goodwill value, and that is attached to your business. So goodwill starts the moment you start trading and continues to grow based on your sales, not net profit. Step 4. So the next month you trade vigorously and now you create $50,000 worth of sales. So what do you have at the end of the month? You still have your $50,000 worth of stock, $100,000 worth of plant and equipment, but now you have $10,000 worth of goodwill. Provided, and for this illustration, we've rated the goodwill at 20 cents in the dollar, which is the multiplier, which I'll show you shortly. But what happens to goodwill if it starts to fail? In the next month, you only achieve $30,000 worth of sales. So what do you have at the end of the next month? You have $50,000 worth of stock, $100,000 worth of plant and equipment, but now you only have $6,000 worth of goodwill. Last month, the value of goodwill was $10,000. This month it is 6,000. So it is directly correlated to the sales you make in the marketplace, provided the margins are still the same. Now, depending on the type of goodwill you have created and the industry your business is involved in, the turnover you have created would now be worth 10 cents, 20 cents, 30 cents, 50 cents in the dollar. But for the purpose of this illustration, we are going to assume that you have created 50 cents in the dollar for every dollar of sales you have created. And according to the chart you can now see, you can see that while the business was growing and maintaining a 50% gross profit margin, the value would stay in a strong correlation. But as soon as the margins diminish and they go from 50 cents to 33, the value comes off. I would definitely ask you to study this diagram to be able to follow it fully. Therefore, the best turnover or revenue streams that can be created are those that are passive or recurring. Cash flow that requires continual input is not worth anywhere near as much as cash flow that makes margin. Earned income businesses are likened to a wheelbarrow. The moment you stop pushing, sales cease or the business is going nowhere. So how do we value those cash flows that are created? Firstly, you must classify them into transferable, locational, personal, or combination. To comprehend and understand the true amount of revenue streams that are transferable, you must profile the revenue streams that have been created and benchmark them to understand where key personnel exist, KPIs exist, and you must understand margins, stock levels, correlation, staffing, etc. Now, in order to value any business correctly, you must find the multiplier. There are basically two systems in the world. The first one I've shown, and most people use it, is completely unprovable. If somebody uses net profit, EBITs or EBITDAs as a base on their calculation, you can be virtually 99% sure that it is not based on market comparison. And then they use a thing called a multiple or a multiplier. That multiple or that multiplier is a guessed figure. It does not come from market interpretation or comparing market sales. So now I want to move to my methodology, which you can see is based on turnover, which is 100% provable. Then we go to the market to find the multiplier via comparable sales. Now, how do we find the multiplier? It's very easy. You have to compare other sales in the marketplace. The first one that we found at 29 cents, that is nearly 50% above the true market line. So you need to understand why someone would pay 29 cents in the dollar for turnover when the market value is around 20 or 21 cents. So then we go to the next sale and we look at the sales that appeared below the line, and they were 17, 18 and 15. You really do need to understand why there are any special circumstances surrounding those sales. And then the other sale where there has been more is 25 cents, and you need to understand why someone paid a premium over and above the true market value. If you know the market value line and can understand it, it will save you from making massive mistakes throughout your life. You cannot value any business unless you investigate every comparable sale within close proximity to the subject business. If you do not know why someone has paid a premium or someone's got a discount, I believe it's impossible for you to value any business accurately. You can't sit at a desk and pull a figure out of the air, yet that is what happens every day. I hope you found this informative. Thank you very much.